try and keep this relatively brief, as I know we're heading into lunch. I'll let you come to your own conclusion as to what my accent sounds like. As I was listening to the last presentation, it was making me think about what Asia was like when I first showed up, and compared to what it's like now, it's like chalk and cheese. There's no similarities whatsoever, and even the changes that have happened in the last 5 to 10 years have been enormous. I would concur with quite a lot of what's been said in the last two presentations about the value of the specific markets. The US private placement market is not to be discounted in any way. The value of the euro market is not to be discounted in any way. The 144A market is real and substantial, and that's where you go for the big numbers. The Aussie dollar market is extremely legitimate, valid, and plays a central role in financing. So, I don't want to stand here today and pitch you that Asia is where you should head to at the expense of everything else. But it is a very, very viable alternative. And that's due to the changes that have happened over the past 5 to 10 years in particular. It's, it provides an alternative source of financing, and we're seeing ever more of it. So I'll go through a few slides. The first one is just the outlook for Asia in 2014. Now, our first contention, obviously, the major economies are growing again, the US in particular, and this is good. This is good for everybody. This is a global scenario. Asia having such a large export sector, it's good for Asia. So no question that US growth is good for the region. Notwithstanding people's concerns about repatriation of funds from emerging markets to the developed world, I contend US growth is good for us all. Euro stability is good for us all as well. Obviously it's been a bit rocky over the years, but as long as the situation in Europe, in the Eurozone, is stable, to a large extent, that can only be a benefit. The fact that the British economy is starting to show good signs of growth, will only further that story as well. If I look back at the situation, with respect to GDP growth within the region, since 1997, it's been pretty much uninterrupted. Prior to that, it was white hot. Obviously, severe dislocation in 97 and the early part of 98. But since then, we've had very impressive rates of growth across the region. The obvious and simplistic view on this is that it's led to a great deal of wealth creation. There are a lot more rich people in Asia now than what there were previously. Where does that money flow? A lot of that money flows into private banking. These people are sophisticated, they're wealthy. Their wealth continues to grow as it's an entrepreneurial region. And the private banks have got ever-increasing amounts of money under management. Couple that with the changes in secrecy rules in various other regions of the world, and you're seeing ever more private banking funds in particular flowing into Singapore and Hong Kong's private banking systems. The other effect is the sheer liquidity in the system. As a result of the macroeconomic situation over the past 5 or so years, rates have been very low in many jurisdictions, and there is a lot of liquidity in the system. If I look at the next slide, this is just merely an illustration. I haven't picked on any particular company, but it shows what I'd like to discuss today. US dollar, obviously, the Singapore dollar and the CNH, or the offshore RMB, and the last two, Malaysian ringgit and Thai baht, point towards the liquidity situation I'm talking about. Both of those countries have got extremely high levels of liquidity in the local and domestic banking system. So there is funds available for investment. When I talk about the US dollar, it was mentioned by the previous speaker, the value of going to Asia to see investors as part of a 144A exercise. I fully concur with that. There's nothing quite like putting pressure on US investors by having them aware that investors in other regions are also looking at the bonds, that there will be competition. If somebody sits back and thinks that they can dictate terms, they probably will. If they're aware that there is a large and interested group of investors elsewhere in the world, it'll force them to think very carefully about the price that they have to pay. So, from both a 144A perspective, very useful, but from a Reg S perspective as well, very useful. A large number of the deals that we see printed for Asian issuers these days are in Reg S format, so less onerous in terms of documentation, and there is adequate regional liquidity to absorb a $300 to $500 million transaction. So, Many of the deals that we do are Reg S only. The issuers don't want to go to the States. They don't see the compelling need to go and meet investors there or sell their bonds there. If they're looking for a relatively moderate size, 500 million would be the right benchmark, but we've done up to $1 billion in Reg S format only. Well, Asia is a solution. It's very possible and it's in the neighbourhood. The next two, Singapore dollars and CNH, this has really been the development of the past 5 years. Singapore is becoming a very, very credible secondary financing currency for companies across Asia and outside the region as well. The liquidity is reasonably large. I'll go into this in greater depth in the next few slides, but liquidity is decent. The swap market is active. There's a high level of governance. Many people are looking at the Sing dollar market. It's actively traded in the secondary. CNH is something that simply didn't exist 5 years ago, and by that I mean the offshore RMB market. I think I'll talk about it in greater length, but to me this is one of the single biggest developments in finance over the course of my career, where the Chinese have gone from not having a convertible or accessible currency market for bonds to creating one. This is an incremental process, and I've got a slide on this, but they're moving towards the creation of the structure for a global reserve currency. They're trying to encourage further trade in their offshore currencies. They're trying to encourage more offshore centres to actively trade in it and gather deposits. And the speed at which it happened and is happening is the part that constantly startles me. I don't get easily startled, but when people saw this kick off, they said it's an odd lot. You can do 2 years, you can do 30 million US equivalent. We're now seeing $500 to $1 billion US equivalent being executed in 5 years plus. The swap market is liquefying. The number of funds that are specific investors in the CNH market in particular are growing all the time. It's evolving very, very rapidly. Now, the last two, as I mentioned, these are smaller sizes and generally shorter maturities. But if there is a specific use of funds required, or if there's an interest in arbitrage, these two are very useful as well. The Malaysian market also has a cyclical angle, which I'll talk about a bit more later. Right. So the value proposition, as far as I'm concerned, it really reflects for three major reasons. For those looking to diversify their US funding sources, there is an alternative investor base in Asia. It's large, it's getting larger all the time. For those with Asian operations and a specific use of proceeds, to be able to raise money in Asia and deploy it locally without the need to swap anything or extensive transfers, it's very useful for local operations. And we're seeing an increasing number of companies who have got operations in the region who are raising money from their local treasuries rather than doing it through head office and transferring. And the third is more relevant for sophisticated issuers who are just looking purely at price. They need a couple of $100 million. There's an arbitrage in the swap markets in the Malay ringgit or the Thai baht, and people are borrowing in those currencies, swapping it immediately, and just getting cheap cost of funds. So all very legitimate in my opinion. No reason why people shouldn't do any of the above. The third one in particular just taps into pockets of liquidity which are available. My next slide is just an illustration of some of the investors that are in the region. There are asset managers galore. Hong Kong and Singapore are the two big centres, but Kuala Lumpur is very significant. Taipei has a good representation. Private banks, as mentioned earlier, have benefited from the burgeoning wealth of the region. Most of the private banking clients that I speak to are typically the owners of a family-run firm. They've got anywhere between $10 and $20 million under management. And their business is going well. Their kids are being educated offshore and are coming back with increasingly sophisticated ideas as to what comes next. But there are a lot of these clients. There's a very large cadre of these. Central banks, sovereign wealth funds and agencies are well represented, from SAFE in Beijing, GIC, in Hong Kong there's the Monetary Authority, there are many. I've got over there insurance companies, obviously, longer dated, Hong Kong, Kuala Lumpur, Taipei, Taipei in particular is an interesting source of long-dated liquidity for high-rated issuers. And then there's the banking system. Across the region, as a result of the macroeconomic conditions, liquidity has been extremely good for half a decade. So there is no shortage of investors. This is not comprehensive by any means. But if you get the opportunity to come to Asia as part of a roadshow, these are some of the people that you'll see. Typically, when we do either a non-deal or a deal roadshow across the Asian centres, we'll do Hong Kong and Singapore, and we'll also use a small centre, Kuala Lumpur, as a good one. Typically, there'll be a group luncheon, 50 to 100 people, and then half a dozen meetings over the course of the day. The number of investors has grown so quickly in Asia that we no longer do one-on-ones. It's typically a small group meeting, 6 or 8 a day. There'll be 3 or 4 investors in each meeting. There's competition for space to see quality issues. As far as the next slide goes, there's a few interesting points. Like China is obviously the biggest game in town with over 40% of the issuance in the region, and that's growing. Every year it's just getting bigger and bigger. People talk about G3 in the region. The reality is most of it's US dollars, particularly the Reg S market certainly. Although the euro is growing, and I think it continues to grow. It offers that pricing arbitrage that we heard about earlier, and I think it's very legitimate. The issuance tenor is 5 to 10 years as a rule. Tranche size is less important, and the credit ratings is illustrative that most of the investor base in the region would like to see investment grade. If you can bring them anywhere from a low BBB to a single A credit, and that really hits the sweet spot. If it's 5 to 10 years, happy days. I won't pay too much attention to the monthly issuance volume, but on the far side, what it points out is that Asia hit almost $140 billion worth of G3 issuance ex-Japan last year. That's a record. I expect that will be very, very similar this year, or probably exceed it. The range of issuers who are coming to market is ever larger. I think we're now hitting critical mass. There's always been a perception that Asia has been a bit of a sideline in terms of issuance, but it's been consistently better over the past couple of years. And despite some volatility, I don't think that's going to change. I think these are the sort of numbers that we're going to see going forward, anywhere between 130 and 160 billion a year for Asia ex-Japan. Now, Singapore dollar, I mentioned earlier, was, I think this is a very credible secondary funding opportunity for regional issuers. 2012 was the high watermark that we've seen recently, with over 31 billion of issuance. That fell last year to about 20 billion. But that's, I think, partly a function that the G3 markets were so good last year for Asia. Many people just looked at dollars rather than going to the Sing dollars. But we do see that whenever the US dollar markets hit a bit of a bumpy patch, the Sing dollar market is there, and it's relatively distinct. The private banking funds in Sing dollar are very, very big, and they can drive a transaction. We did a deal last week for a high yield credit out of Singapore. We expected it would be a relatively small deal, somewhere in the region of 75 to 100 million Sing, so not huge. We ended up with 400 million of demand and printed 200. The private banking funds, particularly in Singapore dollars, are very substantial. The secondary market is active. Most banks who have got a presence in Singapore have a secondary trading desk. So, being able to move in and out of positions, very, very important. And what we've seen also is that an increasing number of issuers from outside Singapore are taking advantage. We're seeing plenty of names out of Europe. Heineken, for instance. Many of the banks have issued in Sing dollars over the past couple of years, particularly capital structures, lower tier 2 or Basel III compliant. The last point is that it's transparent, and there is a reputation for good governance in the country. So, I'm not going to go through this exhaustively, but what it demonstrates is what I pointed to earlier, that the development of the offshore RMB market by the Chinese government is an incremental process. In my view, there's only 2 ways of doing this. They could go for a big bang and just announce it and push it out. That carries a huge amount of risk, particularly when you're dealing with a population of over 1 billion. and I don't believe the world was ready for a big bang in the Chinese offshore bond market and currency situation over the past 5 years. They've adopted an approach which has been very incremental, and the development's been faster than anybody would have expected. We're doing a lot of deals at the moment. This is just the timeline over the past year or so, and the announcements that are coming out every month or every other month are, they're picking up pace. I think the Chinese are working towards being a global reserve currency within 3 to 5 years. Our wise men in research think it's 5 to 10 years. I think it'll be faster than that. If history has shown anything over the past 30 years, the Chinese don't wait around. They do it faster than what people anticipate. And by going step by step, I think they're giving themselves the best chance of getting it right and minimising any risk to the financial system. So this is how we look so far this year. With respect to the volumes that we're doing, like Standard Chartered, I think we did 122 deals last year for the entire year, and it was a good result. We've done almost half that many so far this year. So I think we're very much on track to accelerate and see a bigger market. I do think the change is what I can point to here. The first deal in this market was McDonald's, and they did 30 million US equivalent and remitted the funds. It was a 2-year bond, and they paid up for it a bit. To be honest, it wasn't really cost effective versus US, but it was a benchmarking exercise, and they opened the market. Now we see companies much further down the credit food chain who are accessing this for longer maturities, bigger sizes, and far more frequently. It's not so much what it has been, but it's definitely what it's going to be. The way I think about this is that there is not only in Asia, there's not only an alternative investor base for dollars, there's a specific investor base for this product. So if there is a need for any company to use these funds onshore in China through the quota system, this is a very effective way of going about it, raising funds. The investor base is very distinct. As I mentioned earlier, aside from the private banking source of liquidity, there is now a range of funds that are established mainly in Hong Kong, but also in Singapore, who deal nothing but CNH. So it's dedicated, it's separate, it's alternative. Yeah, so more of the same. Malay ringgit is an interesting one. It covers a couple of different angles. I guess the most important factor is that there is an arbitrage opportunity. 3 or 4 times a year, there'll be a chance to issue something in ringgit and swap it and save money if your funding needs aren't huge. If you're looking for 100, 200 million US equivalent, there is an opportunity in this market on a fairly regular basis when the swaps move into line. And we find that we have a list of clients who are pretty much always ready to go. They'll be standing by, they'll be looking to access it. There's good liquidity in Kuala Lumpur. It's a sophisticated market. There's a strong local domestic market, so there's benchmarking available. It's quite transparent. And there's also a Sukuk element. The Sukuk Malay ringgit investor base is again distinct from the conventional one. There are some funds there that can only buy Sukuk, and for any company that's got Sukuk eligible assets, you can go through the structuring process. There is almost a captive investor base there that can be tapped. With our own bank, we've got Islamic scholars. We have a separate Islamic bank based in Kuala Lumpur who takes care of all of this. It's a very straightforward process, quite interesting from an academic point of view, but the bottom line is that it can be very cheap. Thailand, interesting. I'd say the Thai baht market has been characterised recently by absolutely no activity, and that's due to the political issues going on up there. Talk about a great economy that's being hamstrung by a almost intractable political situation. Whenever I go to Thailand, I'm impressed by the sheer economic muscle of the place. There's a lot of people live there. It's a big and sophisticated market. There's manufacturing base, which is very impressive indeed. But due to the ongoing struggle between those who rule and those who want to rule in the streets of Bangkok, very little has been happening. But I did want to put it up here because in many ways it's the same as the Malay ringgit market. It's, the domestic liquidity is good. I speak to the insurers up there, often I speak to the banks and the asset managers, and they're looking for assets. The process to get approval from the Thai regulators to issue bonds there it's not onerous. It's twice a year there's a selection process. You make an application, they'll let you know whether you're approved to issue or not. It's not as easy as just rolling up and printing a bond. You have to go through a process, but it's it's criteria based and it's reasonably straightforward. And again, it provides an arbitrage opportunity. I do hope that the situation improves there because this has been extremely popular, particularly with Korean issuers. Many Korean issuers, the last basis point absolutely counts, and they keep an eye on the swap markets very, very closely. When there is an arbitrage opportunity, if they've got their approvals in place, they're the first ones to access the Thai baht market. So I'm not going to sort of dwell on this at all. I think everybody in the room understands very clear what a cross-currency swap is, and this applies to all of the alternative currencies that I've just mentioned. So I'll pretty much leave it there. As I said to start with, I'm not up here suggesting that you should turn away from traditional sources of funding. Everything that we've heard about this morning has got its place. I guess my point is that Asia now also has its place. And it's changed so quickly that many people haven't really noticed that it is open for business in a way that it just simply wasn't 5 years ago. From an Asian investor point of view, an Australian credit is a good credit. They look around, they see that the governance and the legal framework here is superior to what they can buy from credits in Asia as a rule. Not everywhere, but the Asian or the Australian system is regarded as being superior in terms of governance and control and legal enforceability, if you like. And there's also a desire for diversity. There's not that many Australian credits who print into Asia. So from a private bank point of view, from that family company perspective with $10 to $20 million under management in a private bank, having an Australian credit on their books is something that they like to see. I'll leave it there, but thank you very much for your time today. I appreciate it.